Well, today's lecture is going to focus on security markets, the third lecture of the semester as the semester progresses. So, there are two different types of markets, and if you've done investments or maybe even managerial finance, you may have come across this before, but if it's a new concept, then that's okay. We have a primary market, we have a secondary market. It's very important for you to understand the distinction, especially when it comes to how firms issue securities and how we could buy and sell securities. Different things happens in different markets. For example, in the primary market, that's where we have a new issue created or sold. For example, an IPO, right? So when Facebook went public, they went public in the primary market. The issuer receives proceeds from the sale. You could also have public offerings versus private offerings. A public offering is when a company goes public, or initial public offering. They're registered with the SEC and the sale is made to the investing public. However, they do have what are called private offerings, where they're only sold to a limited number of qualified investors. Okay? So that's an important distinction there. We don't really hear much about private offerings, but trust me, it's a very active market. In the secondary market, as an existing owner, so if you're an investor and you own a stock or you own a fund, this is the market that you operate in. You could determine to sell, and you could even buy more. So there's no new money created here. The issuing company, for example, let's say Facebook, Twitter, whatever we want to focus on, Apple, they're not getting any new money. The exchange is going on between individuals or institutions, or individuals and institutions, and so on. So for a privately held firm, you could have up to 499 shareholders. There's not as much regulation and obligation to the public when it comes to a privately held. The assumption here is that as a qualified investor, you have not only the money but the acumen for you to know if this is a good investment for you. Get familiar with the word private placement. Primary offerings here are sold directly to a small group of investors. Okay, so it's the same. You might have a company that's coming out with a new product, but instead of going public, they want to raise a lot of capital, but they want to control ownership of their company. They may opt to have a private placement. Now, contrary to that is a public traded company, and we are more familiar with this, right? The Apples, the Microsofts, and we just talked about this a little bit. Here, underwriters purchase securities from issuing companies and resells them. All right, so the underwriter basically comes in and underwrites the value of the shares and the value of the actual overall public offering. And then there's a prospectus that's developed, and the prospectus outlines not only the description of the firm, but also the security being issued. You know, how risky this security is, what's the expectation, what's the benchmark. And it's very important for investors to read this, but sometimes it could be very tedious to also read it. And a lot of people probably don't. So here's an example of the relationship among a firm issuing securities and the underwriters and the public. Okay, so this is how it goes from the decision to the actual implementation. So we have the issuing firm, then they hire an underwriting company. The underwriting company comes in, and then they may sell to several investment bankers. All right, BlackRock, JP Morgan, Fidelity, Wells Fargo. They may have. It just depends on what which company the issuing firm or the lead underwriter feels comfortable with. And then at the point of issue, then each investment company may decide to liquidate or sell their shares to private investors. Okay, so that's all that graph is showing you here. So there's a certain SEC rule, Rule 415 or 415, which refers to shelf regulation. And the security or the stock here has to be pre-registered before it could be offered. Alright, so it has to be pre-registered before it could be offered. And once it's pre-registered, they have 2 years in which to actually issue those shares. There's a 24-hour notice that need to be abided by, and this allows for getting a good sense of the timing of the issue. So when a firm may have this application for this pre-registration, you might start to make the news that, hey, this company is thinking about going public. Well, this is the first step in that process. Then for the initial public offering, they've already pre-registered, they've decided on the date in which they want to go public. We have the roadshow, right? I don't know if you guys were following when Facebook went public, but Mark Zuckerberg got a lot of criticism because while on his roadshow, he wasn't dressed in the suits and the ties and the button shirts. Rather, he was more in his hoodies. And a lot of investment bankers and underwriters thought, well, this guy, the CEO of this company about to go public, he's not taking it very serious. But the purpose of the roadshow is to build a book, right? And to also evaluate the best price. So you want people that are invested in buying it, whether in the private market, or you want as well pricing to be adequate here, right? And usually what you find is, all right, we did the roadshow, we have an idea of what people think the company should be valued at. So the initial public offering is usually underpriced. Underpriced. So it's easier to market the issue. It tends to be costly to the issuing firm at times. However, there's an underpricing element at that first public offering because you want to build up momentum, right? So we hope here that the post-initial sale returns an average of 10% or more. Now, what you found is some companies, they issue and let's say their stock returns or the value shoots up significantly in the first few days, but then they have a sharp decline after. So I guess initially what they're looking for with the public offering is at least a minimum of a 10% or more for that issue in returns. Average first day returns for European IPOs, this might be interesting, and you could always compare it to the United States. So you could look at this graph a little bit more, but you could see Sweden, they tend to have higher than everyone else, right? Germany has a strong response as well. And the United States on average was somewhere around, say, 18 to 19%. That's the average first day returns on most IPOs. For European IPOs. Average returns for non-European IPOs, look at this. Look at China, right? So China, look at their A shares. They could have upwards of 160% return on an average first day. This is very common. And however, there's usually significant declines right after. And if you've been paying attention to what's going on in the market, you will observe that, this is China. They've been at significant losses in their stock market over the last few months. And some once billionaires, because of this effect, have actually lost significant sums of money right after. So what's the function of a financial market? Now, of course, in short, the overall purpose is to facilitate low-cost investments. It's by bringing buyers and sellers together. And we want to minimize that cost. And technology has helped to further minimize that cost. And the whole goal here is to provide liquidity within the market by minimizing the time to trade and the cost of trade. And again, technology has really stepped in here and changed this landscape significantly over the past few years. And the goal here is, as one of the functions, as information reaches the web and the blogs and the social media, we want to reduce information costs. Because if information costs and search costs is too high, it might deter people from investing. So if we could reduce information costs, then we're saying that we probably will be in a better environment to facilitate investing and low-cost investing. And the goal here is to entice everybody who wants to invest. And technically, we should all be investors, right? especially when it comes to planning and saving for our own retirements, this is becoming a real issue for us. Different types of markets, understand the difference between them. You have the direct search market, where the buyers and sellers, they locate one another on their own, right? So they go out and they actively choose, okay, hey, investor A or buyer A, I would like you to invest in X, okay? We have a brokered market where there's a third party assistance. So basically the issuing company or the issuing buyer or seller will go through some individual or intermediary company in order to facilitate that trade, right? So a brokered market, we're looking at some companies that you may be familiar with here, right? You have some of the Edward Jones, some of the wirehouses like Morgan Stanley, Merrill Lynch. They may also fall into this market. We have the dealer market, where the third party acts as the intermediate buyer or seller. So they actually are the ones that buy and then they go back and sell. All right, and then we have the auction market, where brokers and dealers trade in one location. So trading is more or less continuous in the auction market. And then this brings us to different types of market orders, right? Types of orders. And you really need to focus here because they have different decisions, as we'll see in a little bit. But a market order, by definition, is a signal to execute immediately at the best price. Now, we need to know the difference in prices. So you have a bid price. That's the price at which the dealer will buy a security. So I'm bidding at this price. You know, think about if you're on eBay or UBids and you're actually bidding for something. This is the price that I'm willing to buy at. The ask price is the price that the dealer is willing to sell the security at. There's a price contingent order, buy, sell at a specified price or better. Okay, so in the market order, we have execute immediately at the best price. Then we have the price contingent order, so it's contingent on the price, a specified price or better. Under the price contingent orders, we drill down a little further. We have a limit buy order and we have a limit sell order. Alright, so limit buy order and a limit sell order. And this specifies the price at which an investor will buy or the price at which an investor will sell. So the limit buy order is also falls under the umbrella of a price contingent order. So there must be some sort of specified price. And then there's a stop order, not to be executed until the price point hit. Not to be executed until the price point hit. And when this price point hit, whatever the price is, that's when this stop order is going to come in. And this could be very helpful when it comes to wanting to come out of a position really quickly. And some of these orders are very, very important when it comes to hedging our bets, because it allows us to have built-in triggers, for us to respond as investors. So, in the dealer market, we have, it gets even a little bit more complicated. You have the over-the-counter market, all right, over-the-counter. So, the OTC market. You have informal network of brokers and dealers, and they're the ones that go out and negotiate some security sales. And you have the NASDAQ stock market. You should be familiar with NASDAQ. And it's a computer-linked price system. So there's this price quotation system for the over-the-counter market, and then, linked by supercomputers. And that's where you have the NASDAQ. Okay? And then we have electronic communication networks, or ECNs, and like the name suggests, computer networks that allow for direct trading without market makers. And these market makers, they're very important, and you'll learn about them a little bit later, but they're very important for making trades. But an ECN allows you to bypass them, and through a computer network system allows for direct trading. And we have specialist markets, and in the specialists here, they make marketing shares of one or more firms, and they maintain fair and orderly market by dealing personally with some of these specialists.